Join us this morning for the first topic in our KAFL learning series. And the purpose of this series is to highlight some typically complex yet familiar concepts that are relevant in today's environment. And our hope is that you can then build some conversations around these topics into your practice. I'd also like to take this opportunity to highlight that it's KAFL's 30th anniversary this year, since 1991. So expect to hear more on that in the coming months. So our CEO, Peter Skelton, will be presenting today over the next 20 minutes or so. And he'll be discussing grantor retained annuity trusts. There will be a Q&A at the end, so we ask that you please hold your questions till the end of his full presentation. But Lisa Sears will be monitoring our chat features throughout, so feel free to make comments during the presentation as needed. This also will be recorded and shared on our KAFL YouTube channel at the end. So Peter, if you're ready, we can get started.
Great. Thank you, Dana. And good morning, everybody.
Morning.
All right. So our first topic today is planning with GRATs. And I think that you will find that it is one of the most effective wealth transfer tools. So great. We're all here together on a beautiful Wednesday morning. So what exactly is a GRAT? Well, a GRAT is a grantor retained annuity trust. It is an irrevocable trust where the grantor is going to transfer an asset and that asset should have either the potential for appreciation or income distribution to a trust where the end beneficiary is going to receive that in a set number of years, typically from 2 to 10 years. Unlike a irrevocable life insurance trust, where the grantor and the trustee are two separate individuals, in a GRAT, the grantor and the trustee will be the same individual. And what that allows is for the grantor to have complete control over the asset during the GRAT term. During that term of years, the grantor is going to receive a fixed income back from the trust, and the transfer is going to be valued at a gift based upon the initial value of the asset at the time of the transfer minus the present value of the income to be received. Once a GRAT is established, you cannot make additional transfers to that trust during that GRAT term. You can start a second GRAT, but you can't make additional contributions to that same trust. It can be structured so that those payments that come back to the grantor can increase at a rate of no more than 20% per year. And the interest rate that is being used to calculate the annuity is the 75/20 rate, which is a federal rate. It is 120% of the federal midterm interest rate. And what's nice about a GRAT is that it's created through the tax code and regulation. So it offers some very predictable results for us. All right, why is a GRAT an effective tool? Well, when we are looking to try to do wealth transfer to future generations, we really kind of look back at kind of the initial estate planner, the Greek philosopher Archimedes. He said, give me a place to stand and I will move the earth. What he's talking about is leverage. And so oftentimes as we're doing planning, as we're looking at how can we effectively transfer wealth to the next generation, we are really looking for those tools that are going to provide us leverage. And a GRAT does a great job of using leverage. So the first way that a GRAT uses leverage is that transfer value is based on the initial value at the time of the transfer. All of the future appreciation of that asset during the term of the GRAT is not considered as part of what the gift value is. We can also structure a GRAT to zero out. And what that means is that the payments that the grantor is going to receive back will equal the initial value of the asset at the time of the transfer. So effectively, we can create a zero gift asset that transfers to the next generation with no income or gift tax to the recipient. So as a result of that, we're going to be able to transfer wealth at one level of taxation. The money that's going to come back to the grantor as income will be taxed, but the subsequent transfer of the asset to the next generation will occur at no gift or income tax. When we're looking at using a GRAT to transfer a closely held business, we can actually further gain leverage by using valuation discounts. So a discount for lack of marketability, a discount for lack of control, especially if we are either giving minority interest or non-voting stock to the next generation. We can take advantage of those discounts for further leverage. And we're going to use all of this leverage, and the grantor is going to retain complete control of over that asset until the end of the term.
Peter, I had to mute everyone. Can you just unmute yourself? I was waiting until the end of your slide.
All right.
Thank you.
Thank you. So let's take a look at a case study. So this is a closely held business. It's currently valued at between $12 to $15 million. It produces $2.5 million of net annual cash flow. And the owner is thinking that there is likely going to be a third-party buyer and would like to be able to transfer 50% of the stock to the children before that sale to a third party. So what we would do is that we would create two classes of stock: voting stock, which would be held by the owner, and non-voting stock, which is what we would use to give to the children. So we have lack of marketability because it's a closely held business, lack of control because it's non-voting stock. So we're going to be able to take a discount off the fair market value of those shares by 30%. Currently, that the May 75/20 rate is 1.28%. So as long as this stock appreciates at a rate more than 130 basis points, we are effectively taking advantage of leverage and transferring that appreciation to the next generation without any type of gift tax associated with that. So if we just wanted to just give these non-voting shares to the kids prior to the sale, we would take $6 million fair market value, deduct the 30% discount for lack of control and marketability, which would bring the value of those shares to $4.2 million. We could gift that to them and use $4.2 million of our unified credit to do that. The alternative would be is that we now put those 50% ownership into a GRAT. That is going to create $1.25 million of income back to the owner because it's 50%. It does have rights to 50% of the S corporation profits. And in 4 years, that GRAT is going to zero out. The income that the grantor received is going to equal the value of the asset that was put in at the time of the transfer. So now at the end of that 4-year time period, the stock is going to transfer to the kids at 0 gift or income tax. The owner received $5 million in cash flow over that 4-year time period, which can be the owner is going to use for his or her retirement planning. And it happened at the same tax effect as if the owner didn't do a GRAT and just retained 100% ownership of the S corporation stock. When the company is sold, 50% of those proceeds of the sale are already owned by the children or a trust for the benefit of the children and out of the owner's estate. We can also use a GRAT in combination with some other plans. So again, looking at another closely held business, one that's valued at $1 million, taking some discounts for lack of marketability, we can bring that value down to $700,000. And it produces $250,000 of cash flow. In this scenario, the owner does not want to sell to a third party. They have some children that are active in the business and is working on trying to figure out, how do I transfer this business to the kids at the least possible tax cost? So what we're going to do is that we're going to start out and put 40% of the stock, probably non-voting stock, into a GRAT that's going to mature in 3 years. So the owner is going to receive $100,000 in income, net $71,000. That's 40% of the $250,000 of cash flow that's in the GRAT. And the owner is still going to receive the balance of the $250,000 of cash flow, which would be $150,000. So at the end of 3 years, now the children have 40% of the stock. They now have $100,000 of cash flow coming to them directly. That gives the owner quite a bit of flexibility. Either the owner can choose to have the kids buy the additional 60% of the shares so that they have a little pain involved in acquiring the business. We've got some cash flow now to help fund that. We could have the kids go out and get a third-party loan to help buy that. Or depending upon the owner's financial situation, we could do another GRAT for either the entire 60% or some percentage of that. Regardless, if we do sell, that would net the business owner $480,000 net of tax, plus the previous 3 years worth of income. The owner would have transferred the business to the kids primarily at one level of taxation and received back just over $1 million for his or her own retirement planning. So who are the clients that typically are going to need or want to use a GRAT? Well, it's going to be people that have an appreciating asset or estate with some significant tax exposure. The grantor needs to be motivated to make lifetime transfers. If he or she financially cannot afford to do that transfer, then a GRAT is probably not an appropriate vehicle to help with their planning. We do need to make sure that whatever property that we put into the trust is expected to outperform the 75/20 rate. And the grantor is expected to survive the GRAT term. There are some possible solutions that we have. If the grantor dies within the GRAT term, some of those assets are going to come back into his or her estate. So making sure that somebody is not in poor health when we are looking to do a GRAT is advantageous. So what assets can we put into a GRAT? What we typically see is going to be some type of commercial real estate, closely held business stock, whether we are trying to use a GRAT to transfer to the next generation or internal management, or if the objective is that we're going to sell to a third party and we are looking to try to transfer some stock to the next generation prior to that sale. And an investment portfolio that is either high yield or high growth. So some drawbacks to a successful GRAT. The first is that if that asset does not produce income or appreciation equal to the 75/20 rate, then we actually have to use some of the asset in order to make those payments back to the grantor. So effectively, the asset that we put into the GRAT to transfer, a portion of that may have to go back to the grantor to meet the annuity payments. So we want to make sure that we are putting in appreciating assets. If there is death of the grantor occurs during the term, some of that asset is going to come back into the grantor's estate. So we absolutely need to make sure that we are aligning some of their other legal documents, particularly the will, for that possibility, especially if we're putting in closely held stock. We want to make sure that the will designates that that stock is going to go to the business active kids. We can do a couple of things, though, to mitigate the mortality risk of a GRAT. First, if we have a married couple, we could actually split the asset between the spouses, and each spouse could do a GRAT. We can also do what they call either a rolling or a Walton GRAT. It's called a Walton GRAT because this is actually how the Walton family transferred Walmart shares to the next generation. And what this is it's 2-year GRATs, where at the end of the first 2-year time period, the remaining principal of the asset is rolled into another 2-year GRAT. Once that 2-year time period is completed, that portion of the asset is transferred to the next generation and would not come back into the grantor's estate. When we are looking at a GRAT, we do have appraisal fees, whether that be for the real estate or the closely held business. We also have some legal and administrative expenses to that. It is a trust. We do need to make sure that we're drawing up a GRAT with an attorney. We may, if we are looking at a closely held business and that's an S corporation, we do need to make sure that there is special language in there to ensure that the S corporation, that we don't violate the S status of the corporation. We do have carryover basis for the trust beneficiary. So whatever the basis was for the grantor, just like if they made an outright gift to the next generation, their basis is going to carry over to the next generation. And a GRAT is, by definition, a gift of future interest, right? Because the gift is not complete until the end of the term. As a result of that, we cannot use a GRAT for generation skipping planning. It needs to go to the next generation down. We cannot skip over that generation, can't skip the kids and go to the grandkids and use a GRAT. Taxation of a GRAT. It is a grantor trust for income purposes. Whatever the income would have been taxed at. So if it's a portfolio and there's some dividend income, some capital gains, that same taxation is going to be paid by the grantor, whether the grantor owned it directly or if it's owned by the GRAT. If we are putting in closely held business stock or commercial real estate, those rent payments and distributions from the business would be taxed at ordinary income tax rates by the grantor. The taxable gift is going to be equal to the value of the transfer less the retained interest. So again, in many GRATs, what we are going to look to do is to make sure that the retained interest equals the value of the asset at the time of the transfer so that we have a zero gift value at that transfer. As we mentioned before, we can take valuation discounts against the property, and it is a gift of future interest. So if your client is doing some annual gifting to their children, a GRAT would not interfere with that annual gifting that they're doing. So why a GRAT now? Well, I mean, with interest rates as low as they are, that midterm AFR, or sometimes it's called the hurdle rate, makes more assets available to be transferred to a GRAT. As long as that asset is going to appreciate at more than 1.3% per year, we are effectively moving that appreciation out of the estate and onto the next generation without any gift tax consequence. There's some potential estate and gift changes on the horizon. It's a great way to maximize the leverage of our high unified credit that we have today. And for closely held businesses, the private equity field is very aggressive right now. So as we're looking to try to do some estate planning for successful business owners, perhaps we want to do a GRAT, move some of that stock to the next generation in advance of a sale to private equity. GRATs are just a great way to start that conversation with your clients. We've had so many changes that affect clients' estate planning with the Secure Act, affecting qualified money and being able to take lifetime distributions from the beneficiaries, as well as also that merger and acquisition market. GRATs are just a great way to approach some of your clients, and it's a tool, one of several tools that you have available to be able to try to pick up leverage and transfer wealth. What we really need in order to take a look at a GRAT calculation is the value of the asset or value of the company. If you're working with a business owner that does not know the value of their company, we can do an informal valuation to at least start the planning and determine what that GRAT value should be. We need the discounted value of the interest to be transferred. Again, that's mostly with qualified or closely held businesses, and what the projected cash flow is with respect to the transferred interest. So either the investment returns off of a portfolio, the rent incomes off of commercial real estate, or net distributions from closely held business. It is an exciting time for doing planning with clients, more than ever when we are in periods of change. Your work with the clients in trying to get them to do some planning ahead of time is a vital component for your client's retirement success. And we look forward to helping you with some of those planning opportunities. All right, that concludes our presentation for this morning. We do have scheduled for the next upcoming segments, sale to intentionally defective trusts, as well as also charitable remainder trusts. So look forward to those. And we've got time for some questions. Happy to try to answer those.
I do have some questions from Dave. Dave, did you want to ask those directly to Peter, or I can read them off for you?
Sure, I can ask them.
Sure.
So I know you talked a little bit about the type of analysis, cash flow and that sort of thing that goes into understanding whether these are appropriate. They kind of feel, in a sense, complementary to an ESOP in some cases. And I was curious, in an ESOP's case, there's a lot of feasibility analysis and cost that goes into that. It seems like this is an easier process to consider when it comes to preparing for, moving forward with something like this. Is there anything else in addition that typically goes alongside an analysis on these?
So I think that where I would start first is with the business owner's own personal financial situation and making sure that they have sufficient assets to drive the cash flow that they need for their retirement lifestyle. Because the GRAT is really, how am I going to transfer the assets that I don't need for myself to the next generation? So that would be where I would start first, Dave. And then certainly the GRAT analysis is not going to be nearly as comprehensive or as involved as an ESOP consideration would be for a company.
The second kind of follow-up I had, or actually I have two. Does the entity ever end up taking out loans or using leverage to actually provide for the cash flow to make payment on the transfer? Like that cash flow in the first case study, the 4 years of cash flow, does a business have the ability to obtain leverage to be able to pay that off, or does it need to be entirely from kind of the cash flow of operations in the business?
Yeah,
in that business example.
Yeah, so great question about, so the annuity payment that goes out to the grantor is the only mechanism is the net income from the business to go out there. No. So as long as the business can provide that cash flow, whether it be from their net income or from a loan from a third party to the business that then is distributed to the GRAT, any of those scenarios would be available to it.
Okay. And then finally, when you're talking about the income being taxed at basically the marginal bracket of the grantor, in an S corp status, does that mean that the 20% pass through is what applies there, or does it end up hitting again kind of the marginal bracket under ordinary income?
It would be yeah. So the tax rate would be the marginal tax rate for the grantor.
You could actually lose a little tax efficiency of that income, right? Then if I'm understanding that correctly, what would ordinarily be passed through at 20% to the business, hitting the employer basically as a 20% pass through. If he's in a higher marginal bracket or she's in a higher marginal bracket, they're going to end up paying more in that than they typically would, right?
They could, yes. Yep. So we would just kind of evaluate that as compared to, okay, what does that look like if we, against the alternatives of getting the stock to the kids? So, and there's, lots of different ways that we can look at trying to do that. It could be an outright gift to the kids with then some deferred compensation that the business is going to pay the owner. So there's several different strategies that can be utilized. We would just kind of evaluate each of those with the GRAT being in the mix.
Thank you.
You're welcome. Good questions.
Peter, this is Sean Becker. I've got two questions, and I'm not surprised that Dave's questions were deeper dive than mine will be.
Morning, Sean.
Sorry, Dave, you stepped into that one. Did I hear you correctly? And can you clarify that what kind of trust can be the beneficiary of a GRAT? And number two, can a member of a PLLC use this tool?
So the trust would be an irrevocable trust for the benefit of the children. It could also be for the benefit with allowing for discretionary withdrawals or distributions to the spouse during his or her lifetime, and then ultimately for the benefit of the children.
Okay.
And so for a professional LLC, as long as the end beneficiary met the criteria in terms of the profession. So if we had a medical practice, the end beneficiaries would also have to be medical professionals. But the GRAT itself could
Can handle it. The GRAT itself
could be a vehicle to transfer it as long as the end beneficiary was qualified.
Great. Thank you very much.
You're welcome. Any other questions, Lisa? Anybody else?
I do not have any other questions in the chat.
Great.
We did have a
Well-
question about the upcoming dates. We'll finalize some of those dates and I will send out a save the date. If you're not receiving thanks, Reeve. If you're not receiving the original invitation, please feel free. I put my email address in the chat to email me, and I'll make sure we do have a lot of lists in our the way that we send out the invitation. So if we want to make sure that everybody that wants an invitation is on our list. So please feel free to reach out to me.
Great. Well, thank you for everybody for taking some time out of your morning to join us. And if you've got any follow-up questions, feel free to reach out to either myself or anybody on the marketing team. And we look forward to helping you throughout 2021. And thank you, Dana, for your introduction this morning.
Thanks,
Have a
Peter.
great day, everybody.
You too.
Thanks, Peter.